Okay, greetings, folks. Hopefully you can hear me. Josh, are you there?
I am here.
Okay, looks like we've got about 25 people or so in this session, which is intermediate partnership concepts. And it's being presented by myself, Glenn Langford, and Josh Reifel. Josh put the slides together. And we're going to try and do this as kind of a discussion format. Josh will present the slides, and I'll interject as needed, or he'll pass it to me as we go on. So we'll try to make a discussion out of it, even though we're in separate rooms and can't see each other. And the way we'd like to work is if you have questions, go ahead and raise your hand or use the chat function as we go along, and we'll try to answer whatever questions come up. So with that, we'll get started. Josh?
Okay, just to add on to that, I don't think I heard you mention it, Glenn. Just remember that you have to stay signed in for the entire presentation, and there will be 6 code words that will be presented throughout the presentation. So if you want to bring up your feedback form and just drop the words in as we present them. So,
yep.
So moving on, we have. All right, so some of the topics we're going to talk about today in this presentation, we'll do a brief overview on basis, and even though it's not really necessarily an intermediate topic, it does kind of form the foundation of many of the other items we're going to discuss. We'll talk some about partnership debt and liabilities, distributions, making a 754 election, and expand on that with section 743 and 734. We will discuss, probably in pretty good detail, section 704C, and its effect on partnership basis and the property contributed under that section. Talk about sale or exchange of partnership interest, and a few other items we'll touch on. Section 199A, section 163J, both of those were presented this morning, so we'll just briefly talk about how they affect partnerships. We'll talk briefly about UBIT, investment partnerships. We will look briefly at talk briefly about the 2020 Form 1065 and K1 and any new items related there, as well as looking forward to next year, 2021 tax year, so 2022 filing season, but some developments, especially with the Schedule K1 that we need to be aware of as we're going through this next tax year. So like I said, partnership basis, not really an advanced issue necessarily, but it's going to form the foundation of some of the things we're talking about. So in general, partnership basis is going to be the value of property contributed to a partnership, whether that be cash or other forms of property, marketable securities, tangible property, real estate, etc.
Actually, Josh, not the value of property. It's your tax basis is the tax basis of the property you're contributing.
Correct. Wrong choice of words. Yes, the basis of property contributed, which if it was cash would be value as well, but for other things, tax basis and value could be considerably different, as we'll see. And that's increased annually by gains, decreased by losses, decreased by distributions, and in a difference between partnerships and S-corps, liabilities also increase basis in a partnership. And that's one of the reasons why when you're looking at a Schedule K1, one of the differences between the K1 for a partnership and for an S-corp is that in a partnership, it shows the liabilities allocated to that partner or share or a member, LLC member, if you're filing an LLC as a partnership. And the reason is those liabilities give additional basis in a partnership. Another difference between partnerships and S-corps, when we're talking about that, is in an S-corp, you can have multiple interests in an S-corporation. Say if you purchase 10 shares of an S-corp in year 1, and 3 years later you purchase another X number of shares in that S-corporation, your basis in those is going to be different. So if you sell one or the other, your gains and losses on that sale are going to be treated differently. Whereas in a partnership, your basis it continues along. If you put additional money in, it increases your basis. If you take money out, it decreases the basis. But whether you sell it in year 1 and year 10, however many times you've contributed or taken distributions, your basis is going to remain just the continuing flow of information.
So a partnership interest is fungible. So I should point out also with regard to basis, Josh had mentioned contributions of cash or other property, and added to that is income or gains, which includes tax exempt income. And then he said subtracting deductions or losses, and then distributions. The ordering can actually be important though, and the way it actually works is your basis is increased by contributions of cash or other property, and by income or gains, including tax exempt income, and then from there you deduct distributions of cash or other property, and then deductions and losses, and that can have the effect of limiting the ability to deduct losses in a partnership, because you're reducing your basis by distributions first. And then the partnership liabilities, to the extent that they change year to year, an increase in a partner share of partnership liabilities is treated the same as a contribution of cash. A decrease of partner share of partnership liabilities is treated as a distribution of cash. So a partner could wind up having to recognize gain on a distribution on simply the reduction in their share of partnership liabilities if it exceeds their basis. So anyway, I just want to add that.
Thank you.
Okay.
And we have our first attendance code word is basis. BASIS, basis. Give you a second to write that down or enter it into the form. And continue on. Okay, so one of the things leading off of talking about basis in general is the new requirement, and this was touched on briefly this morning in the first session by, I think David Harris talked about it a little bit, is the new requirement for tax basis reporting for partners in a partnership. This was supposed to be required back in 2019, but the IRS actually was feeling generous or gracious and decided to postpone for 1 year after it was recognized that it might take more work than the time allowed for preparation of this. And basically what this is, and it was alluded to this morning, is that in the past, partnership capital or basis has been able to report it on in a few different manners, whether it's tax basis, 704, excuse me, 704B, or I mean, you could really have other. You could have book basis. And there was a catch-all other, and you just had to explain it. So now, starting for partnerships beginning on 1/1/2020 or after, the tax basis must be reported on Schedule K1. So what that means is the beginning capital for partnerships that have not used the tax basis previously is going to have to be refigured. So before you do anything, or while you're doing your preparation this year, you're going to have to go back and recalculate the beginning capital amount so that it's reflected under tax basis. And the IRS has prescribed 4 different methods for refiguring, or 3 different methods actually. The tax basis method has been used previously, but 3 methods for refiguring the beginning tax capital basis. And those are not very detailed, but they are described in the instructions for the Form 1065. As you're going through and preparing for the next tax season, I would recommend going and reading those. But the 3 methods are modified previously taxed capital, modified outside basis method, or Section 704B method. And just a brief overview on each of them. The modified outside basis method, the amount to report as a partner's beginning capital is adjusted tax basis as determined under provisions of subchapter K, and subtracting from that the partner's share of liabilities under Section 752 and the sum of 743B adjustments. Modified previously taxed capital method, the beginning capital amount is equal to the amount of cash the partner would receive if the partnership liquidated after selling all assets in a fully taxable transaction for fair market value, increased by the amount of tax loss determined without taking into account Section 743, and decreased by the amount of tax gain without taking into account any Section 43B basis adjustments. In the 704B method, the amount reported as a beginning capital under the 704B method is equal to the 704B capital minus the partner's share of Section 704C built-in gain in the partner's assets, plus the partner's share of Section 704 built-in loss. So, as David indicated earlier this morning, it could take a lot of work depending on how capital has been tracked or traced throughout the previous couple of years. Again, the instructions for the form are not the most specific, but they give broad overview. So something to hopefully something that we've all been kind of looking at throughout this year, that we know we're going to have to do. But there's definitely going to be some work that has to be done to get the beginning capital correct.
So, Josh, one thing that's important also to realize is that tax basis capital and a partner's tax basis in their partnership interest are not necessarily the same thing. Because, for example, the as Josh mentioned, I think in his explanations of the different methods, Section 743 basis adjustments, which we'll get into a little bit later, are not taken into account in calculating tax basis capital, but they are a part of a partner's tax basis. And also, as I think I said before, a partner's basis in their partnership interest includes their share of partnership liabilities. Well, the partner's capital account does not include liabilities. That's separately stated on the K1. So again, the partner's tax basis capital on their K1 is not necessarily their tax basis. And just kind of highlighting a couple of things that Josh mentioned about the different methods. The outside basis method that he mentioned, this would be used in a case where the partnership, for whatever reason, can't determine from its own books and records what a partner's tax basis is. You can actually the partnership can actually rely on information provided by the partner as to what their tax basis is, their outside basis, from which they would subtract or take into account 743B basis adjustments and partnership liabilities. The previously taxed capital method, which is kind of a backwards way, kind of backing into tax basis, is where you take what a partner would receive in a distribution liquidation if all the assets were sold for fair market value, and subtracting from that the gain or loss that would be allocated to that partner on that liquidation to arrive at tax basis. Again, it's kind of backwards. And then the 704B method is essentially tax basis with the exception of 704C, which we'll talk about. Well, you can see on the slide we're going to talk about it. So anyway, so Josh, you want to talk about the net unrecognized 704C, or you want me to, or?
You can. That's fine. I can pick up the next slide.
Okay, so
and we have more detailed discussion on it later on.
More detailed, but basically 704C 704C gain or loss is the difference between the fair market value of property contributed to a partnership and the tax basis of that property to the contributing partner. So if I contribute a piece of land that's worth $10,000 to a partnership and my tax basis in it is $1,000, there's a $9,000 Section 704C pre-contribution gain on that. Now, 704C also applies in what's called reverse 704C allocations, where And you may have seen this if you read a lot of partnership agreements, you've probably seen this. So if a partner makes a contribution, down the road, not at the outset of the partnership, but later on, a partnership agreement, oftentimes you'll see a provision in the partnership agreement where capital accounts will be revalued whenever a new partner comes in or additional capital is contributed. So, for example, Josh and I are partners in a partnership, and our capital accounts are we're 50-50 partners, and our capital is $50 each. And somebody else comes into the partnership and they contribute $100 for 1/3 interest. Well, that $100 1/3 interest would indicate a $300 value in total. And if the partnership agreement so provides, you can revalue the pre-existing partner's capital accounts, essentially bump up the capital accounts for book purposes, not tax basis, by $50. So everybody's capital for their 1/3 interest is $100. And then that can result in what's called reverse 704C allocations. So hopefully that made sense. Okay. And then, well, I guess I'll just cover the last thing on this slide, the at-risk reporting. That's separate and apart from tax basis, really. And the way I like to look at it is when you have a trade or business activity, there's really 3 hurdles you have to cross before you can deduct a loss from that trade or business activity. Number 1 is basis. You got to have tax basis to deduct the loss. Number 2 is you got to be at risk for the loss. And then number 3 is the passive activity rules, which we're not going to get into in this discussion. So the difference between basis and at risk is I can have basis in a partnership interest to the extent of the capital I contributed and gains allocated to me and all that. And also, as Josh mentioned, partnership liabilities. But if those partnership liabilities that are allocated to me and provide basis to me are non-recourse, in other words, I'm not personally liable for them, then I'm not at risk. And what that means is that if there's a loss allocated to me that exceeds my tax basis capital, and I have non-recourse liabilities, I've got basis to claim that loss, but I'm not at risk, so I can't claim it. Now, and the difference, a little bit of a quirk in at risk versus basis is for tax basis purposes, if I get a distribution in excess of my tax basis, I have gain. Whereas if I get a distribution in excess of my at-risk amount, that's not taxable. So at-risk works to limit losses, but doesn't result in recognition if you have a distribution in excess of at-risk. So you can have a distribution that you have sufficient tax basis to cover, but not be at risk and not recognize gain. Okay. Yes, you want to move on, Josh?
Okay. And as an aside, more information on all 3 of these points here, the tax basis reporting, the unrecognized 704C gain or loss, and the at-risk reporting. There was a notice 2019-66 that talked about the delay, the deferment of that from 2019 to 2020. And there's more information in there, as well as references to where you can find more information. So if you want to go and look at that, it is out there. Right. We already talked about these in the last slide. It was just, again, these are the 3 methods that you can use to convert your beginning tax capital or your beginning capital basis to tax capital basis for those that have not done so in the past. All right. So we've kind of talked a little bit about debt. Glenn mentioned a little bit about this during his discussion on the at-risk rules, but if you've seen a partnership K1, you'll know that there's 3 types of partnership debt. There's recourse, non-recourse, and qualified non-recourse. Glenn already kind of touched on the non-recourse debt. This is debt in which no partner or related person bears the risk of loss. So this would be something like, quite often your accounts payable, or that would probably be one of the bigger ones, or just some general loans that the partnership may have had as well. Recourse debt, that's going to be debt that one or more partners or persons are going to bear economic risk of loss. So maybe it's that the partnership is brand new and they want to get a loan, but since it's a new business, the bank requires one of the members to sign as a guarantor on the loan. In that case, that person who signs, that would be recourse debt to them. And like Glenn alluded to, that would give them at risk, which is the second hurdle that he discussed. And qualified non-recourse, this is actually kind of a separate category. It doesn't fall into the same section as recourse and non-recourse, but qualified non-recourse debt is debt borrowed in connection with the activity of holding real property. So rental real estate businesses, that kind of, you see them a lot in that. And that type of debt actually does not fall under the rules of at risk. So it's kind of a separate category that you're only going to see when you're dealing with real property partnerships. Did you have anything else you wanted to add on debt before I move on, Glenn?
No, I think you pretty well covered it.
Okay. All right, so moving on to distributions. So as a brief discussion, distributions versus guaranteed payments. So guaranteed payments would be, well, in a way, they're just what they sound like. They're payments that are guaranteed, but quite often they're going to be inside of a partnership agreement in which certain partners, maybe all partners, all members, are going to receive a payment for services that they provide. And could be a specified amount, it could be a specified percentage of something, but it's going to be something that's guaranteed. Guaranteed payments are deducted from income, so indirectly they will affect your basis, but not in a direct sense, in that when you get a K1, your guaranteed payments don't further reduce basis. So they're deducted from your, generally speaking, box 1, ordinary trader business income. Whereas distributions are just a distribution of cash or property by a member that does decrease their basis. And this could be anything from as simple as a partner saying, my taxes are due, I need to take a distribution from the partnership of X dollars, in which they do. Or it could be at the end of the year, partnerships may distribute cash or property at the end of the year to partners or members. But again, the key is that does decrease basis. And as Glenn said, that actually decreases basis before you take into account any losses. So
Josh, let me pipe in for just a second on with regard to guaranteed payments, and just want to stress the importance of distinguishing between what's a distribution and what's a guaranteed payment. A guaranteed payment is payments to a partner that are determined without regard to the income of the partnership. And so let me give you an example. So let's say we've got Josh and I form a partnership, and we each put in $50. And Josh is running the partnership. I'm just an investor. But we're 50-50 partners, and the partnership agreement says we share income 50-50. But we also have a deal where, because Josh is running the partnership and I'm just an investor, Josh is going to get $10 right off the top. So let's say the partnership makes $50. All right. So Josh is going to get, and the $50 is going to be distributed. But Josh is going to get $10 right off the top. And then he's going to get $20 of the remaining, half of the remaining $40. So he's going to get $30. And I'm going to get $20. Now, if we treat that whole $50 as distributions, well, Josh got 30 and I got 20, which means Josh's capital at the end of the day is 60 and mine is 40. Because that $10 that Josh got for running the partnership is really a guaranteed payment, it should be deducted from income. So instead of 50, the partnership's income is 40, and we each got 20, and Josh got a $10 guaranteed payment on top of that. and Josh gets the benefit of the half of the deduction of the guaranteed payment. I get the benefit of half of it. And you can see where that can make a difference, not only in partners' separate income, but also, can make a difference on the exit, because if on liquidation, distributions are made based on partners' capital, well, partners' capital got skewed if you treated what should have been a guaranteed payment as a distribution. Okay, I think that's all I want to say about that.
Okay. One thing that I want to kind of mention or briefly talk about with guaranteed payments versus distributions, as I kind of talked about I mentioned at the beginning, we're going to kind of talk about a little bit how 199A factors into partnerships. And one big way in that is, historically, a lot of operating agreements for partnerships may have been written that gave guaranteed payments to members. And now with the code section 199A, that could actually be a bit of a downside, a bit of a negative. So, like I said, the guaranteed payments, they're going to reduce the ordinary income that a partnership distributes to its members. That line one, generally speaking, on the K1. But to a partner, the guaranteed payment is not qualified business income, so that has no effect on their ability to calculate the 20% deduction. Whereas on the other hand, a distribution does not affect the ordinary trade or business income. So in effect, you're getting more of that income in the box one, in what would be qualified business income, which could potentially allow for a greater deduction. So of course, it doesn't affect if you're subject to self-employment income with any of the partnership income, whether it's in box one or the guaranteed payments, it's still going to be self-employed income. So it doesn't really affect that. But it might be that because more of it is in box one, you could take more of a deduction under section 199A. So something that you may want to look at, have your clients look at with their operating agreements. Maybe they want to revise them to remove the guaranteed payments and just pay out as distributions, assuming there's enough basis available to do so. But that might be a way to help your clients get more benefit out of the section 199A, depending on their tax situation. So in terms of how distributions affect basis, cash distribution is pretty easy. If you get cash, you reduce your basis by the amount of cash you receive, because the basis of cash is the same as fair market value. So if you get $100 in cash, your basis reduces by $100. Property distributions are slightly different. So this would be if you got, if the partnership distributed land or a building or even a desk or a computer, any piece of property. If it's a current distribution, meaning that the partner is not leaving the partnership, the partner's basis in the property equals the partnership's basis. So if you give a partner a distribution of land that has a basis in the partnership of $1,000, it reduces the partner's basis by $1,000. Now, in a liquidating distribution, meaning the partner is leaving the partnership, they are liquidating their interest in the partnership, the partner's basis in the property equals the partner's remaining basis in the partnership. So if I give this piece of land worth $1,000 to a partner who's leaving, whose tax basis is $10, well, then that piece of land has a basis of $10 to that partner. So it's remaining capital in the partnership, remaining tax basis. Distribution of fair market securities, or of marketable securities, sorry. The basis equals the fair market value. So that's a slightly different situation where you're distributing marketable securities, is that it's not the basis, it's the fair market value. So it's almost treated as if it's cash.
And it causes gain recognition if they're appreciated securities.
Correct.
Gain recognition to the partnership.
The partnership, right. All right, in this last bullet point here, debt financed distributions. These are something you're going to see quite often. I mean, a lot of times, maybe, Helene, looks like you have your hand raised.
Yeah, just quickly, Glenn, on that distribution of securities, and the partnership has to recognize gain. Is that the only asset to which that special rule applies?
Yeah, so the way it works is distributions of marketable securities generally are treated the same as cash and distributed at their value and result in gain to the partnership, unless there are three exceptions to that. Unless they were originally contributed by that partner. So partner A contributed 10 shares of General Motors and then got a distribution the next year of 10 shares of General Motors. That's not a taxable event. Secondly, if the securities were not marketable when they were acquired by the partnership. So in other words, the partnership acquired some private company or something that went public later on. And then thirdly, if it's an investment partnership, and an investment partnership, which we'll talk about a little bit later, generally it's a partnership that's never been engaged in a trade or business, and substantially all of its assets are cash or securities. And substantially all, I think, is generally considered to be 90% or more. So where were we? On a distribution, I mean, there can be gain recognition on a distribution of cash if it exceeds basis, like we talked about before, but that's gain recognition to the partner. Gain recognition on a distribution of marketable securities, if it applies, is at the partnership level. Does that answer your question, Lane?
Yeah, I guess, yes, it does. But I also, are there any other assets that would be treated that way besides marketable securities?
Where you write them up to market value when they're distributed?
Right.
Oh.
Okay, thank you.
And also point out, well, we'll get into this later, but for an investment partnership, it's kind of backwards every other partnership. For an investment partnership, you don't recognize gain on a distribution of marketable securities, but you do recognize gain on a contribution of marketable securities, which you don't for a regular partnership. So anyway,
okay.
You want to go on from there, Josh?
Yep. So as I started talking about debt finance distributions, this is an instance where a distribution is taken or is given or taken by a partner or multiple partners, where that distribution has arisen from debt, basically, from either refinancing or taking out a new loan. So a good example of this would be in a rental real estate property. If the partnership owns, has a rental real estate property and they have a mortgage that has a remaining balance of $500,000, and it's 2020 and the mortgage interest rates have dropped to near historic lows, so they decide, okay, let's go ahead and refinance this loan, take some cash out, and so they refinance the loan for $1 million. All right, so now they've paid off the original loan and they've gotten an additional $500,000 in cash. All right, if that cash is distributed, or some of that cash is distributed to members, that's what's called a debt finance distribution. And the reason this is really important is the deductibility of the interest expense that results from that debt finance distribution depends on how each partner or member uses that distribution that they received. So, for example, if Glenn and I own a partnership, we refinance the loan on our rental real estate property, and each of us gets $250,000 of the $500,000 extra cash, and I go and I invest that $250,000 in another business that I have, say a Schedule C, well, that's considered business interest. And I can deduct the full amount of that business interest on my individual tax return when I get my K-1 from the partnership. If Glenn goes and he invests that in some businesses that he doesn't participate in, some businesses he invests in, that would be investment interest, and that would be subject to the Schedule A investment interest expense deductibility, wherein he could deduct that only to the extent that he has investment income.
Josh, what if I take my money and buy a boat?
Well, that would be considered personal use, in which case the interest would not be deductible at all. That would be a non-deductible expense. So I'm sure you could get a nice boat for $250,000, but any interest from that debt would not be deductible. And I want to apologize. I actually I misspoke there. If you invest in, if you take that money and invest in a business, that's subject to passive income rules. So if Glenn takes that money and puts it into businesses that he invests in that are passive, that he doesn't participate in, he can deduct it only to the extent that there's passive income. Now, where the investment income rules come into play is if Glenn takes that money and buys a bunch of stock. That would be subject to the Schedule A investment limitations. So it's very important. A lot of times if you get a K1, that the interest expense that is related to that debt finance distribution is going to be, or should be, separately stated on the K1. Usually it's going to be under box 13, other deductions quite often. And there should hopefully be a footnote saying this represents your share of the interest related to the debt finance distribution. So you may have to go back and talk to the taxpayer and say, what did you use this money for that you got the distribution, in order to determine how to properly take that distribution or that deduction or not on their individual tax return. So that is a very important distinction there. So how do you calculate that? We'll go through a quick example. So again, using my example that I was talking about before, a loan on a rental real estate property with a remaining balance of $500,000 is refinanced for $1 million. $250,000 of the excess cash is distributed to the partners. So in effect, 25% of the loan that was received was distributed. So 25% of the annual interest expense needs to be reclassified as debt finance distribution related interest and reported separately. So that's basically how it's calculated, right? There's the basic tenets of how it's calculated.
So, Josh, that would be, in the year that the loan is refinanced, that would be the calculation going forward. Future years, a portion of the interest on the debt would still be considered debt finance interest, but there are some special rules you can use to kind of reduce the amount that's debt finance interest more quickly than saying that's 25% of the interest for the life of the loan. You can, for example, you can treat expenses paid in a subsequent year as having been paid with a portion of the proceeds of the loan, and therefore reduce the amount that was treated as being distributed to the partners.
Correct. So each year that amount would reduce. This is the first year calculation right here.
Yeah.
So yes. So yeah. It could be that in year 2 it might be 24%, then down to 22, 21, etc. So it's it needs to be recalculated every year based on the ratio of the amount of cash that was distributed to the partners, as reduced by, as Glenn was saying, by various means, as a proportion to the entire loan, balance of the loan. We have our attendance code word 2, which is distribution. Distribution. I'll give you a second to write it down, enter it into your form. A little longer word, so I'll make sure you have a chance to make sure it's spelled correctly. Okay. And moving on. All right, so we briefly touched on section 704C earlier. We talked about that in reference to the reporting requirement that would have been in 2019 and is now in 2020. And one thing we kind of failed to mention, or didn't really talk about, is that even though the requirement to report the net unrecognized section 704C gain or loss was postponed until 2020, that line still was on the 2019 K1. So maybe you got some K1s from your clients and they had that information entered in there. So it wasn't required, but in a lot of cases the information was still provided. So I guess some preparers were getting practice on how to do this going forward. So the main purpose of section 704C is essentially to prevent permanent deferment of gains or losses on appreciated or depreciated property contributed to a partnership. And we'll look at an example of how this would work, but basically it's saying that you can't contribute a piece of appreciated property. So say you have, a piece of land that you have a basis of $50 in, but is now worth $500. You can't contribute that to a partnership and have the partnership sell it immediately and have that gain kind of allocated among all the partners in order to reduce your taxable income. So it's a way to prevent you from deferring or permanently avoiding any gains on property. And it also serves to indirectly eliminate any differences between book and tax capital accounts. And again, we will see in a couple of examples how that works. And this applies to future allocations of income, loss, or deduction generated by contributed property. So it's not just whether or not you contribute it and sell it. Section 704C can come into account, for example, with depreciation. There could be different forms of depreciation or different book and tax depreciation methods used that would be allocated separately based on this section 704C. Before I move on to examples, Glenn, I know we talked a little bit about this earlier, but do you have any additional comments on 704C before I do examples?
Sure. So again, as Josh said, 704C is the rules for how to account for differences between the fair market value of property contributed to a partnership and its tax basis to the contributing partner, or in the reverse 704C scenario, a difference between the fair market value of partnership interest has booked up under the partnership agreement and the tax basis of partnership interest to the partner with the booked up capital account. And so in the simplest example, and I don't know if it's one of Josh's examples or not, so if I contribute a piece of property with a basis to me of $10 and it's worth $100, then if that property is subsequently sold for $110, the partnership's basis is 10 because it was my basis when I contributed it. So the partnership's gain is 100. 90 of that 100 gets allocated to me first. That was my pre-contribution gain, the difference between the $100 value of the property I contributed and the $10 tax basis that I had in it. Okay. And so, well, want to go on to your examples because I can't remember if your examples cover this stuff anyway.
They might. If not, we can expand on them. So
this is what I just said.
This is basically the example Glenn just gave. So X and Y form a partnership P. X contributes $100 cash. Y contributes land with a basis of 50 and a fair market value of 100. So as far as inside the partnership, each partner has a basis of $100. But for tax basis, X has a tax basis of $100, the fair market value of the cash, or the basis in the cash, sorry. And Y has a tax basis of $50. So if the land is sold for $100, that $50 tax gain, there's no book gain because we're selling it for fair market value, which is the book amount. But the tax gain is allocated entirely to Y, who at that point will then have both tax and book basis of $100. And everything is even across the board now. So that's the most basic example. It's basically what Glenn just said. So moving from there. All right, so now we have the same set of circumstances, except the property is now depreciable property. It's not land, it's something else, something that's subject to depreciation, and it's not sold immediately. And the property is depreciated for simplicity purposes, straight line over 5 years. So we had a book value of $100, which means that every year the depreciation is $20. And we had tax basis of $50, so the tax depreciation is $10 a year. So the book depreciation is allocated to each partner 50-50. So now at this point, after we depreciate this property, if nothing else happened to the year other than depreciating property, each partner would now have a book basis of $90. $100 of the cash in the property that's contributed, less the $10 allocated each partner. All right, now the tax depreciation, on the other hand, in this case, this is going to be allocated to the non-contributing partner, which in this case was partner X, to the extent of book depreciation. So what this will have an effect of doing is, at the end of the year, Y, who contributed the land, will still have their $50 tax basis, the basis of the land or in this not land, property they contributed. They'll have the $90 book basis. X, the partner who contributed cash, now has their $90 book basis, and their tax basis will now be reduced down to $90. And then the year after that, if nothing else changes, the tax basis of partner X would go down to 80, 70, 60, 50, to the point where both partners had the $50 tax basis. And if the land is sold for $100, each partner recognizes half of the tax gain. At that point, there's no more pre-contribution gain that's unrecognized, and you move forward from there. Attendance code word 3, that was quick. I didn't space those out very well. Debt, D-E-B-T, and it looks like we have a question from Andrew.
Yeah, hey Josh, can you go back to the first example you had there with the land?
Land. This one?
Yeah, so what if we sell the land and it has a different fair market value than when it was originally contributed? Like if it has an increase or decrease in value since it was contributed.
Okay, so if it has an increase in value, then let's say we sell it for $150. Okay, now the first $50 tax gain, that's still going to be allocated to Y. That's going to be, like Glenn said earlier, that's the pre-contribution gain. All right, then we have the additional $50 beyond that, beyond what would, the original fair market value was. That'll be split 50-50 between the two partners. If, for example, the land depreciated in value, and there is an example on that later, but I'll touch on it now. If the land depreciates in value, the entire tax gain is still going to be allocated to the contributing partner. The only difference in this case is that you'll have to do additional work in order to bring book and tax basis into alignment to where they would be had it been sold at the original fair market value. Does that answer your question, or do I need to go into it more?
I think it does. So like if it was sold for $80, for example, you'd
allocate $30, the $30 tax gain to partner X. And then as we'll see in a future example, you would have to take and...
Wait a minute, Josh, the $30 tax gain would get allocated to Y because he was the one who contributed the land.
Oh, sorry, yes, it would be Y, yes. I'm getting my X's and Y's mixed up. Yes, it would be allocated to the partner who contributed the piece of property, which in this case is Y.
Okay, thanks.
And then there would be several corrective, there's possible corrective measures that you can take to realign tax basis to where you would want it to be, and we'll look at that in a moment. So, okay, so that. Okay, did we all get the code word debt, D-E-B-T? We got that right at the end of the first hour, so that must mean we're right on track, I hope. All right, so now the ceiling rule, this kind of plays into what Andrew just talked about in terms of what you would do in the event that something is sold for less than its original fair market value. So the ceiling rule basically states that income, gain, loss, and deductions cannot exceed 100% of each item recognized by the partnership. So, and this might get a little complicated, so if you do have questions, please ask. We're getting a little more in depth here. So,
yeah, well, basically what it means is that you can't allocate gain if you don't have gain. You can't allocate gain to one partner and loss to another partner. In general, that's why they call it the ceiling rule. You can only allocate what you have.
So A and B form a partnership, AB. A contributes $1,000, and that should say it's $1,000 cash, just to clarify, that should be $1,000 cash. And B contributes land with a fair market value of $1,000 and a $600 tax basis. So far, we're in a similar situation to the last example, different numbers, but basically there's a $400 pre-contribution gain that if the land was sold immediately for fair market value, B would be allocated the $400 tax gain. All right. However, in this particular case, the land is going to decrease in value to $900 and is sold for $900 cash. So there's a $100 book loss. That would be the difference between the $1,000 initial fair market value and the $900 sale price. That book loss is going to be split, in this case, 50-50 between partners A and B. And you now have a $300 tax gain, all right, which is less than the initial pre-contribution gain for that piece of land. So if you're trying to bring book and tax capital basis into alignment, you would think that allocating $350 gain to B and a $50 loss to A would result in ending book and tax capital of $950. However, you can't do that. There's only $300 of tax gains, so you can't just allocate what you don't have. So in this case, the $50 book loss to each partner, you got $100 book loss allocated 50-50, and the entire $300 gain is going to be allocated to B. So now B is going to have book capital of $950, their original $1,000 fair market value of the land less the $50, and tax capital of $90, which is not where we want to be. The idea one of the ideas behind 704C is to eliminate the variances. All right, we still have a variance of $50, but now the property is gone. So there's no more pre-contribution gain that's in the partnership that can be allocated. All right, and this can be resolved by using various curative methods.
Oh, and you also in this example have not only is B's tax basis and tax capital and book capital not come into line, but A's is off. Because in this example, so A would be allocated to $50 book loss, would have $950 book capital, but still $1,000 tax capital.
Right.
So their book and tax is actually being skewed.
Skewed in the opposite direction.
Yeah.
So how to fix this? The curative, you can use curative allocations, and these are tax allocations only. So that's a key point. Is you don't do anything with the book allocations. That $50 book gain, that's allocated 50-50. You don't touch that. But now you're going to have some tax allocations. And tax allocations are reasonable to the extent it does not exceed the amount necessary to offset the effect of the ceiling rule. So using the previous example, you could do, if you could allocate additional tax gain, $50 tax gain, not book gain, but tax gain to B. So you basically take $50 of tax gain away from A, which would reduce their tax capital down to $950, and allocate that tax gain to B, which would increase their tax capital to $950. And now across the board, you've got book and tax capital at $950, and everything is where it should be.
So and the reason, as Josh said, you can't these 704C allocations, the curative allocations are tax allocations only, and the reason why we say that is that these allocations should not affect the economics of the deal. I mean, the tax rules can't affect the book allocations because the book allocations are the economic deal. The economic deal is that who are they, X and Y or A and B? I can't.
We're at A and B in this partnership.
A and B. So so in this example, after the sale of property, there's $1,900 in capital, and A and B are 50-50. So their book capital should be $950 each. Now, as Josh was talking about the curative allocation, so the basic, the traditional method of allocating in 704C is your basic, the first example. B contributed property with basis of 500 and fair market value of 1,000. It was sold for 1,100. B got allocated the first 500, which was pre-contribution gain, and everybody's book and tax capital lines up, and everything's hunky-dory, and you keep going. Where you run into having to make curative allocations, there's what's called the hold on a second, I just had a message here. What's called the traditional method with curative allocations is where, and you may have seen this reading a partnership agreement if you like to read partnership agreements, a provision for example, something called a qualified income offset. So that would be where you could actually make an allocation of, you can't allocate more than the amount of gain that you have. So in our example here, we had a $300 gain, and the capital accounts were going to be skewed if you just allocated the $300 gain all to B, and the book gain of 100 between A and B 50-50. But you could, if it's provided for in the partnership agreement, you could allocate some other item of income. Let's say that, aside from selling land, there's actually a trade or business in this partnership, and this trade or business generates gross income. You could actually allocate income, even gross income, to partner B in order to bring them in line, basically allocating it away from partner A to partner B. And you're not allocating something that doesn't exist because you do have gross income. You're just reallocating that gross income between partner A and partner B to even things up. Aside from the traditional method and the traditional method with curative allocations, there's also a third method called the remedial method. And no, it's not for people that are slow. This is in the remedial method, which again, all these are tax only. In the remedial method, you can actually allocate things that don't exist in certain circumstances. And that's, you can make up income out of thin air and allocate it. You can allocate, if it requires allocating tax depreciation to partner A, you can actually allocate negative depreciation to partner B. And that's only if, you can only use a remedial method if you have a book tax difference in a non-contributing partner, which would be like in our example, I guess the second example, where the property was sold at a loss, and as a result of that, you wound up with partner A having a $950 book capital and $1,000 tax capital, and they were a non-contributing partner. Does that all make any sense? Hopefully. So you have under 704C, you have the traditional method of allocating the pre-contribution gain, the traditional method with curative allocations, and then the remedial method. And you're probably not going to see the remedial method too often. Okay.
Right. Hopefully you generally have items of, gain or loss to allocate. On to our fourth word already, capital. C-A-P-I-T-A-L, capital. I feel like I'm in a spelling bee again. I've done that in a few decades.
I was going to use harder words.
That's why I chose them. Okay, so hopefully we've gotten the fourth word by now, and we're going to move on. Okay, so we're going to move on to, and we're going to talk about actually kind of reordered this from the outline in the beginning of the presentation, but sale or exchange of partnership interest. And the reason I'm going to talk about this first is we're going to go into some elections that go along with sales and exchanges of partnership interest afterwards. So I felt it was better to talk about this first. So sale or partnership. So as a kind of just a matter of note, the sale of a partnership interest versus sale of partnership assets. So there is kind of a difference in that. And the reason I bring that up is because when I was a brand new preparer long time ago, and partnerships were, I was dealing with a partnership that may have been dissolving or, shutting down operations, and they sold all the assets and they wound down the partnership. Well, whenever I went to go ask a question, I said, well, they're selling the partnership and I don't know how to deal with this. Well, they're not selling the partnership. They're selling the assets, and there's a difference. Selling the partnership assets, that's an internal sale. So basically, that's the partnership itself selling whatever the partnership holds, property, whatever, to a buyer. Gains and losses are going to be recognized at the partnership level, and then, of course, allocated down to the partners via the K1s. But the gains and losses are all going to be calculated internally. Whereas a sale of a partnership interest, that would be if Glenn and I are 50-50 owners in a partnership, and I decide that I'm done, I don't want to deal with this anymore, but the business is still profitable and we want it to keep going, and Glenn still wants to keep it going, I can take my interest and sell it to somebody else, in which case they're buying directly from me my interest in the partnership, and I'll recognize the gains and losses on my 1040. So there is a difference between that. You can also sell partnership assets and still have the partnership going. Now, I don't know what you would do without any assets in the partnership, but you could theoretically the partnership could sell all of its buildings, land, property, and they're not selling the partnership, they're just selling everything in it and just kind of going along as a shell of something. So there is a difference between the two, so make sure that you're aware of that. Anything else to expand on that?
Changing the subject a little bit, I just wanted to point out there another distinction between selling a partnership interest or selling a partnership, or actually not a partnership, I shouldn't put it that way, selling an LLC, for example, which is treated as a partnership, versus selling the assets. And this is a state and local issue. If a partnership sells its assets and those assets are in Pennsylvania, Pennsylvania is going to want tax on the gain on the sale of those assets. Whereas if the LLC, whose members, none of whom are Pennsylvania residents, if each of the members sells their interest in the LLC, well, their partnership interest is an intangible asset. So that gain would be sourced in their resident state. And Pennsylvania would not be able to tax it. And also, for example, if you had a sale of real property, or you had real property in this LLC, if you were to sell the real property, you would likely be subject to assorted transfer taxes in whatever state the property was in. If you're selling the LLC interest, you're not going to have that. So that's something to think about in terms of strategy relating to a sale or exchange of a partnership interest versus partnership assets. So sorry about that, Josh. Go ahead.
No, please. Okay, so, and now we're going to go and get into is what's called a Section 754 election. And the Section 754 election allows, well, it says a step up, but allows a step up or step down in basis.
Wait a minute, Josh.
Yep.
Josh, can you back up a second?
I can.
To the other slide. The other thing I wanted to point out on, Charlie just brought it up. That's what I wanted to bring up. A partnership interest, as I said, is a capital asset, but for certain purposes, a partnership is an aggregate rather than an entity. And Code Section 751, which Charlie pointed out, requires a look-through of the partnership if the partnership has what we call hot assets. Hot assets are inventory or unrealized receivables And those terms are a little bit misleading because unrealized receivables includes things like depreciation recapture. So basically it's things that would result in ordinary income if they were sold. So when you sell when a partnership sells assets, say for example you have equipment that's been depreciated, when the partnership sells that equipment, there's going to be depreciation recapture on that sale, and that depreciation recapture is going to be ordinary income, and that's going to pass through to the partners. If the partner sells his interest in the partnership, you have to look through the partnership to the assets of the partnership, and the partner will have been deemed to have sold his interest in that equipment. And so a portion of his gain, even though it's a capital asset that he sold, a portion of his gain will be ordinary under Section 751. And I should point out Section 751 can also apply if you have a disproportionate distribution from a partnership where gain is recognized. So let's say you'd have a disproportionate distribution if the partnership redeemed a partner. You would have to look through the partnership to determine whether the partner would need to recognize ordinary income on some portion of their gain, assuming they have a gain. Sound good to you, Charlie?
Sounds great. I attended a IRS webinar, and the presenters suggested that that's something they're looking for.
Oh, sure. Yeah. Yep.
Thank you.
Okay. Well, wherever we were, Josh.
Okay. Yep. Thank you for that. Going into the next slide, Section 754 election. As I was starting to say, this allows a step up in basis of assets with a partnership when there's a distribution of partnership property, which falls under Code Section 734, or when there's a transfer of interest by a partner under Section 743. So under Section 743, partnership increases the basis of property by excess of fair market value over basis, and it creates a 743B capital account for the transferee partner. And we'll look at an example in a moment as well. Under Section 734, there's an increase of basis of property by the amount of gain recognized by the distributee, a decreased basis by loss recognized by the distributee, and does not apply to any distributed property which is another interest in another partnership.
Well, first of all, it's important to point out that the distribution of partnership property or transfer of interest has to be a taxable event. It has to be a taxable transaction. So, in other words, if the partnership is making a distribution, but the distribution doesn't exceed the partner's basis, the partner who received the distribution, there's no gain to be reported. There's no potential step up in basis. And then likewise, the transfer of interest, if a partner sells their interest, then that's a taxable transaction. If a partner dies, that's considered a taxable transaction because there's a step up in basis of the partnership interest to their estate. If a partner simply gifts his partnership interest to a child or whatever, or assigns his partnership interest to his revocable trust or something of that nature, that's not a taxable transaction. And so the step up, the basis adjustment in 754 election would not apply. Also want to point out the 754 election is permanent. It can only be revoked with the IRS commissioner's consent. So you do kind of have to be careful with it. And Josh said something about doesn't apply to distributed property, which is an interest in another partnership. That means another partnership that doesn't have a 754 election.
Correct.
Yeah. Okay.
Great. You allocate increase or decrease in basis according to Section 755, which Glenn, if you'd like to go into section 755 as well, and I'll pick up on the examples.
Yeah, basically it's the where you have a 754 election where you have a step up in basis on the transfer of a partnership interest, that that step up is allocated among the remaining assets in the partnership based on their fair market value. So if I have, for example, say there's a transfer of a partnership interest, I'm making this up as I go along, that resulted in, say it was a 20% partner sold their interest. The partnership has cash of $1,000 and a piece of property that's worth $10,000 and has a basis of $5,000. And they sold their 20% interest for, I guess it would be $2,200. And they had a gain of, say, $1,000. That $1,000 basis adjustment, you would look at the balance sheet of the partnership. Partnership has $1,000 in cash, and a building that's worth $10,000 has a basis of $5,000. The basis adjustment is going to get allocated to the building. And the reason why, one reason why a 754 election can be advantageous, even though it's permanent, is like in my example here, where the basis adjustment is being applied to a building, a depreciable property. That means you can increase the amount of depreciation claimed on it. Also, if you have property that's likely to be sold, a 754 election makes sense because if you don't make a 754 election and the basis in the property that's later sold isn't adjusted, if the property is sold but the partnership's not liquidated, the gain on the sale of the property is going to be based on its original cost, not with no step up. And that gain is going to pass through to the partner who received the transferred interest, and they're going to have to recognize that gain, even though which would be greater than what they would have to recognize had a 754 election been made. Where you generally don't want to make a 754 election is things like securities partnerships, because securities, of course, fluctuate a lot more than some other things, and there's some other ways around that for securities. Let's see, where were we? So anyway, so under 755, you allocate the basis adjustment based on the fair market value of the properties remaining in the partnership. Okay?
Okay. All right. Attendance word 5, property. P-R-O-P-E-R-T-Y, property. Give you a moment to write that down. And no, I'm sorry if you're looking at it. Unlike the first words this morning, they do not form a sentence. So I'm trying to read it. It's not making any sense. That's just because there's no sense to them. All right. So looking at an example of section 743. So in this case, A is going to sell their 1/3 interest in partnership ABC to D for $100,000. Partnership ABC has assets with a tax basis of $180,000 and a fair market value of $300,000. So that would make sense why A is selling a 1/3 interest for $100,000. So that's the fair market value, 1/3 of the full fair market value. All right, so A's tax basis in the partnership is $60,000. That's 1/3 of the overall tax basis of $180,000. So what you have in effect is D paying $100,000 for something with a basis of $60,000. All right. So in this case, A is going to make a Section 754 election under 743, the exchange or sale transfer of partnership interest. And ABC's basis adjustment is going to be $40,000. That's the difference between the basis of the property of the partnership interest and the fair market value that D paid for it. And that basis is going to be, that adjustment is going to be allocated entirely to partner D, the new partner, which brings their essentially brings their basis up to the amount that they paid, the $100,000 that they paid in order to acquire this interest in the partnership. Okay.
And if that basis adjustment is allocated to depreciable property, then the is treated as a new asset. So if it's a residential building, it would be depreciated over 27.5 years, beginning with the date of the transfer, and the depreciation would be allocated all to D.
Partner D, correct. All right. Now, just to kind of reiterate what Glenn said, this Section 754 election is permanent. So in this case, they made this election here, but say 2 years down the road, maybe C sells their interest, but maybe then it only has a fair market value overall of $100,000. So now they sell their interest for $30,000, or I guess that would be $33,000 for 1/3. So in this case, you may have to make a negative or a step down in basis. So then you're actually kind of reducing the basis of the assets that are remaining, which would reduce the future depreciation. So there are upsides and downsides to it. So just be aware of that. But every time there's an exchange, there's a sale of a partnership, you need to look and see if an election was made in the past, because you may have to, or you will have to, if it was made, make these adjustments if the election was made previously, or if it hasn't been determined, if you want to make it going forward. All right. Now there is a mandatory step down in basis. All right. This is not technically under Section 754 because 754 is an election. This is not an election. This is mandatory. This is required when there's a substantial built-in loss for property, or also when there's a substantial downward basis adjustment. And the threshold for this is a $250,000 entity level adjustment. All right. When there's a $250,000 adjustment, then this becomes mandatory. No longer an election. Now, Glenn, if this happens, since it's not an election, if in the future there's subsequent transfers of interest, is there any requirement to make adjustments down the road?
Sorry, what do you mean? So
if in year one there's a mandatory step down in basis,
right?
But then 2 years down the road, we have a situation where there's a sale like we had in our last example. Would there be a requirement, or could you make or not make the election at that point?
You could make or not make it at that point.
Okay.
I mean, the mandatory step down is not the same as making a irrevocable election. I mean, it's a one-time thing.
Right. So the mandatory step down in basis does not preclude you or require you to make the election in subsequent years. But making the election obviously locks you into it, as we stated.
Right. And do you have an example of 734?
I do not.
Okay, so as Josh mentioned, the 743 basis adjustment is where there's a transfer of interest, and the basis adjustment is allocated all to the transferee partner. 734 is where you have a basis adjustment resulting from a distribution by the partnership. That would be in the case of a distribution and redemption of a partner's interest where they recognize gain or loss, or a distribution in excess of basis for a partner where they have to recognize gain. And in that case, the basis adjustment is allocated under 755, just like normal, to the assets remaining in the partnership based on their fair market value, but it's not allocated to a specific partner, because the partner who receive the distribution is either out of the partnership or their basis isn't adjusted. Their basis went down to zero because they got a distribution in excess of basis. So the 734B basis adjustment essentially is allocated amongst all the remaining partners. And just to kind of try to tie this together, if you recall, we talked about 743B basis adjustments when we were talking about tax basis capital. And we said that 743B basis adjustments are not taken into account in tax basis capital, which is one of the things that that means that tax basis capital and a partner's tax basis and their interest are not necessarily the same number. So this is what we're talking about, the adjustments under 743B where you have a transfer of interest. They're ignored for purposes of tax basis capital reported on a K1. Okay?
Okay. All right, switching gears almost entirely, getting away from basis now a little bit, and any basis calculations or adjustments. Partnership audit rules. These have been in effect now for, I think, 2 years, if I'm not mistaken.
Since 17, or years beginning after 17, I guess.
Right. Okay. So this will be the 3rd year coming up then. So basically, under the new partnership audit rules, the audit and assessment is done at the partnership level rather than the partners. This requires the election, the selection of a partnership representative. It used to be called the tax matters partner. Now you have the partnership representative, who would be basically the representative in the audit. And basically, under the new audit rules, if there's any assessment or tax assessed, it's actually assessed at the partnership level, and it's the partnership's responsibility to pay it. And then they can choose whether or not to go and collect from the partners, if they have to go back to partners who may have been in the partnership during the year of audit but aren't anymore. Makes it a bit more of a logistical nightmare in some cases, probably, for the partnership. So there are a couple of ways to elect out, or there's a way to elect out of this partnership audit regime, but there are a couple of stipulations on it as far as what the requirements are to elect out. So, and the requirements are kind of similar to the requirements of, in this first one at least, fewer than 100 partners. So that's kind of a similar rule to, the S Corp rules. No partnership can be another partnership, or no partner can be another partnership, a trust, or a disregarded entity. All right. And in the case of a S Corp partner, so an S corporation can be a partner, and the partnership can still qualify to elect out of the audit regime. However, any shareholders in that S corporation do count towards the 100 partner limit. So if you have an S corporation that has 500 shareholders in it, well, that exceeds the 100 partner limit. So that partnership can elect out of the partnership audit rules. And when the partnership does elect out, there's a Schedule B2, I believe, that is generated that lists out all of the partners in the partnership. So basically, it's telling the IRS, we're electing out. Here are all of our partners. That's who you're gonna look to during an audit. So that's kind of the basic rundown on the partnership audit rules. Glenn, if you'd like to expand any more, or if you think you're
so the partnership level audit. Well, the centralized partnership audit regime, which is what they call it now, replaced the old TEFRA. And TEFRA was the Tax Equity and Fiscal Responsibility Act of, what year was it, Charlie? It was 1982, something like that? I can't remember. Anyway, and TEFRA provided for a partnership level audit, but not for the thanks. But not for the tax actually to be assessed to the partnership. The partnership would be audited, and then the IRS would go to each partner and make their adjustments based on their audit. The centralized partnership audit regime, as the audit is performed at the partnership level, and the partnership is responsible for the tax unless they push it out to the partners, which they can do within certain time constraints. And that's what I thought, 82. And I lost my train of thought. And so the as Josh mentioned, there's a potential election out of the centralized partnership audit regime if the partnership has 100 or fewer eligible partners, and eligible partners being individuals, C corps, S corps, and foreign entities that would be C corps if they were domestic, own estates. And as Josh mentioned, for S corp partners, you have to count the individual shareholders. But curiously, you don't have to look to the S corp shareholders to see whether they're eligible partners. So in other words, you could have a S corp shareholder that's a trust that would not be an eligible partner under the centralized partnership audit regime. But if they're an S corp shareholder, then it's fine. But anyway, so, and to my thinking, if you can elect out of these rules, it makes sense to do so, because if you're not subject to the centralized partnership audit regime, then the IRS has to audit through the individual partners. You know, they basically, they can't audit the partnership, they have to audit the individuals, and that and I think that will result in fewer audits related to partnerships. And I just think it's, you know, if I just can't think of a good reason not to elect out if you can. Okay.
Okay. All right. A couple of other partnership items. So section 163J. Now, these first two, the 163J and the 199A, we discussed a little earlier. We'll kind of touch on them a bit. As far as 163J, you may get K1s that'll present any excess business interest expenses separately. That's under, I think, 13K now, or at least it was last year on the K1. So something to be aware of if your client receiving, the partnership. You have to look at their particular tax situation and whether or not they're subject to 163J, and then apply the rules appropriately. And again, of course, if you're preparing a partnership, then obviously you have to look at the partnership with it, whether or not it can elect out of the rules or not. So yeah, I've probably only worked on a couple of clients that are subject to it, but it does happen. You do find that the businesses are going to be subject to that, in which case you have to present the information through the K1 so that the partners can act accordingly. 199A, the one big thing I wanted to talk about there was, earlier I mentioned the difference between guaranteed payments and distributions. Something to look at if you want to discuss with your clients or within your businesses, to look at whether or not you want to restructure your operating agreements to provide for distributions versus guaranteed payments, whether that would be advantageous or not, in terms of increasing the possible deduction for the ultimate taxpayer. So that was kind of the big note right there. As I indicated earlier this morning, on K1s, all the information is presented into one statement now, or under one code under line 20. It was 20Z last year for partnerships. So all that information is presented separately in a statement that you have to actually go through and weed through to look at what information is necessary or not. And there are a number of different things that flow through a partnership that can potentially affect the deduction, such as obviously the net business gain or loss, any self-employed health insurance. Like I said this morning, that needs to be deducted from the business income as well to get towards the deduction. Similarly, some things you may have to look at as well, charitable contributions. If a partnership makes charitable contributions, that information actually needs to be passed through on the 199A statement. And if the taxpayer, so say it's an individual, if they're taking itemized deductions, then those charitable contributions would also reduce your QBI amount. Basically because the charitable contributions are reducing taxable income through additional itemized deductions. So I think that's the logic behind that one. So that's kind of where we're going on that one. As far as investment partnership rules, Glenn, I think if you want to take the last two bullets on the investment partnership and the UBIT reporting.
Okay, well, I mean, investment partnerships we touched on earlier, that unlike other partnerships, contributions of marketable securities to an investment partnership in general are taxable. Distributions of marketable securities, unlike regular partnerships, are not. And there's special rules for that are designed to address issues like diversification. So, for example, if if I own $100,000 worth of General Motors stock and I want to diversify, well, I would have to sell my General Motors stock and buy other stocks, and I might recognize a bunch of gain. Whereas, without rules against it, or recognition rules, I could contribute my $100,000 of General Motors stock to a partnership that has a diverse portfolio, and all of a sudden I've got a diverse portfolio. So that, I mean, it's not something you're going to see too often, but it's something to be aware of. Then, with regard to the UBIT reporting, that's unrelated business income tax. If a partnership has tax-exempt entities as partners, that could be charitable organizations or retirement plans or any exempt organization, there are special reporting rules because the partnership has to be able to determine whether any income coming from the partnership is subject to unrelated business income tax. And I don't have a K1 in front of me. I don't know what codes they are on the K1, but there are special reporting rules for that. And so I guess that's it for that. I did want to put up. Is there another slide, Josh?
Yeah, there are a few more slides.
Oh, okay. Then yeah, we'll make it to it. Go ahead.
Okay, so looking briefly at Form 1065 and Schedule K1, couple of new items for 2020. Of course, you can get this if you look at the 1065 instructions right there on the first page of the instructions, or any form for that matter. There's a section that says what's new. So I took these three from that section right there. There's a Schedule B question now regarding significant foreign acquisition of the partnership that needs to be answered. And looking at the K1, apparently the K1 codes are no longer going to be listed on page 2 of the Schedule K1. So that's the page that you get that has, the full-size page with microscopic print that tells you what each line and what each code means. Well, I mean, if you look at last year's, the 2019 codes, half of them just said see other instructions because there were so many of them now. That's a result of the simplification of the tax code. Obviously, there's more things now, which is easier. So apparently there's not going to be a page 2 with the codes anymore. If you look in the instructions, there's a reference of where to get those codes so you can see what they all are. And there are, of course, various credits that were discussed this morning from coronavirus relief packages. And I forgot to change coronavirus to one word. Somehow it's still 2 words on this slide. No, it's not the beer virus. It's coronavirus, COVID-19. But there are various credits that you're going to have to take into account when you're filling out and completing Forms 1065 this year. And just looking ahead to the future, to 2021, which starts, actually, I think you can almost see 2021 in a long-term forecast now, depending on what source you get your weather from. So be aware of that. It's around the corner. In the past, and including this year, foreign income and expenses have been reported on a partnership, line 16 of a K1. Line 16, I think A through whatever, R.
X, I think.
Whatever letter, yeah. Well, starting in 2021, those are going to be replaced with schedules K2 and K3. And schedules K2 and K3 are about 20-ish pages long each. So instead of a couple lines in a K1 for foreign income, you're now going to get upwards of 40 pages for foreign income and deductions in a K1. So tax report papers are going to start getting incredibly long in some cases. It's just something to be aware of, that going forward, as of right now, foreign information is going to become much more detailed in this presentation. I think after that, we get to final code word of the day, vacation. Hopefully we all get to take some vacation here coming up soon, because as we've talked about, between tax basis reporting and recalculations required under that, and future developments, as well as trying to navigate all of the intricacies of the CARES Act and the various other acts, we're going to need some vacation, because it's going to be a busy tax season again. But hopefully it will be normal and it will end on April 15th. That's the desire, instead of going all year. So Glenn, I think that's the last slide, if you have anything else that you wanted to contribute.
No, I think, well, we're 4 minutes early. Does anybody have any questions? And if not, maybe we'll just take an extended break.
So
thanks, Josh. Good job.
thank you. If anybody has any questions throughout the next couple of weeks or month, well, next couple of weeks, not too many questions, because we're going on vacation, as is code word 6. So, but going into next year, if you have any questions, please feel free to come and ask us. We're glad to help you out with anything that was presented here or other partnership issues. Aside from that, I guess we